Hi there, nice to have you with us. Our guest in the studio this evening is Estienne de Klerk, who's the chairman of the REIT committee. It's part of the Property Loan Stock Association of South Africa. The reason why I didn't explain what we're going to be talking about is because I need to also understand what all these entities are before we get there. Hello Estienne, nice to have you with us. Okay, let's start now with this Property Loan Stock Association. What do you guys do there?
So the Loan Stock Association is basically an association of all the listed property companies on the JSE, and this association really represents those companies as a collective bargaining kind of representation. It deals with issues of promoting listed property, education of investors, and it deals with a variety of issues like taxation, which is the relevant discussion for today.
Okay, so you're for want of a better word, you're like a lobby group for that particular
100%,
sector.
that is exactly correct.
Okay, and you're there to represent them and extract the best value you can on their behalf.
Absolutely.
For underneath this Property Loan Stock Association are various committees. You're chairman of the REIT committee.
That's correct.
What is that now? And why is it so important?
Absolutely. So most jurisdictions internationally, the USA, Australia, and most developed jurisdictions have something called REIT legislation, and it's a sort of collective name for the investment in listed property, and it's a tax regime that is provided for international real estate investment. And why is this important? Because most of our pension savings internationally resides in real estate. It's a perfect investment vehicle for real estate, and as such it deems a requirement for a specific tax legislation. And what really the tax legislation provides for is a flow through. So you own property in these vehicles, and they have expenses. Some of them have a bit of debt, and those expenses are all deducted, and then on a 6 monthly or quarterly basis, all revenue is then paid out to unit holders. So effectively, by owning investment in one of these company shares, if you'd like, it's the same as owning a small piece of the underlying property assets, and the entity itself does not pay tax. It's tax neutral.
Okay, I just want to come back to a point you made there. Why are so many pension funds, and I take it you're saying South African pension funds, why are so many invested in offshore property?
Well, most of the...
What makes property so attractive to
Yes.
pension funds in particular?
Yes. Okay, so I think there's two questions there.
Yeah.
The first is, why do pension funds invest in property? I think in the South African context, there's something called Regulation 28, which deems that 25% of their investments have to be in prudential investments, in other words, lower risk investments. And property is classified as a prudential investment,
Okay.
which is together with bonds and cash and other cash instruments, cash-backed instruments.
So it's a
very predictable
asset allocation.
Absolutely, it's an asset allocation issue. But what makes property a great preservation vehicle for wealth is that it's got a predictable cash flow, and over time it's usually, if well managed, got a growing income return. And as such, a lot of the world's wealth resides in real estate across the globe. When looking at the South African market, our pension funds generally invest in local listed market, which has had an aggressive development phase over the past 10 years. And then certain of them also have international mandates to invest in international listed property companies that own, for instance, shopping centres and office buildings and industrial property, or hotels for that matter.
Okay, right. Thank you for explaining that one. Now, let's come back to this whole system. Just unpack it a bit more for me about how these entities become tax neutral.
Okay, so if you go and analyze a normal operating company, let's say a bank or a widget making entity that's it could be listed or non-listed.
Yeah.
Effectively, what would happen, it would have revenue, it has expenses, and it generates, ultimately, if it's doing a good job, net profit. Now, obviously the receiver wants his piece of that, and that helps fund our fiscus, and that is called taxation, and that's then deducted usually prior to dividends that are distributed to its shareholders.
Right.
Because property is so unique in that it's such a wealth preserver and it's a investment vehicle for pension money, it makes sense to have a total flow through of that revenue, so that it's tax neutral effectively. So what happens is these vehicles that have REIT status effectively own rental, they have expenses, they have maybe a little bit of interest on debt, and then the distribution is paid to unit holders on a gross basis. Those investors then are taxed on that income. The income they will receive is then deemed to be rental in their hands.
Okay, so there's not a sort of double taxation in the process. That money flows through to the investor, and that's where the tax comes in.
100%. And as a result of that, of this legislation, double taxation is effectively eliminated.
But hang on, if you're saying that you're busy working on this now, does that mean at the moment the double taxation does exist?
The industry has synthetically, let's say, avoided or structured itself in such a way that that double taxation does not exist.
How the heck did you do that?
So if you go and look, and there's two different entities that exist at the moment. The one has legislation in place, and they are unit trust companies. So you have unit trust companies that are operating property entities. Now, there are certain limitations as to, or benefits and liabilities as to those structures, and they're not really suited for a operating property company. The second entity is a property company, and how the tax neutrality is established is that most of the revenue, or net rental if you'd like, is paid to unit holders via interest. So every unit holder owns a share stapled to debentures or to a loan instrument if you'd like, and they trade indivisibly, and usually all the profit is then paid out on these shares in the form of interest. Now that interest is obviously revenue in the investor's hands, and if you're a pension fund, obviously you're neutral, and once you pay out your pension to the pensioner, he pays tax, whereas if you're an individual investor, then you pay obviously tax on all the revenue you receive on these units, you pay tax. So that's how the entities to date have been tax neutral. Where there has been tax leakage in specifically the company structure is should the entity sell a property and make a profit, then there has been capital gains tax to date, which clearly there's then a double taxation scenario because there's also capital gains tax to the investor buying and selling the shares, which is not ideal.
Okay, now this particular tax setup, you mentioned the US, UK, Australia, Belgium, France, Hong Kong, Japan, Singapore. They all have this in place. I take it you have gone and looked at what they have. I mean, firstly, is what those countries have all very similar?
So they do differ around the fringes, but the basic principle of tax neutrality is a fundamental of REIT legislation across the world. So you might find that the structure in Australia, which is a trust structure stapled to a company structure, is slightly different from the US, where it's a pure company structure usually that has certain aspects of real estate investment. So they do differ slightly, but the principle across the globe remains the same. And for South Africa to be competitive and to be able to attract capital into this very capital intensive business, we have to move on in life and get this legislation in place.
Okay, I want to come back to that point a bit later. But where are you at the moment? You've obviously done your homework and you've engaged with Treasury or
That's right.
The receiver?
So the Property Loan Stock Association and effectively the industry approached National Treasury probably about 5 years ago, and raised the specific issue with them, and we have been collectively working with them over a period of time, and in the past 2 years we've made quite a lot of progress to the point where in April the National Treasury in their latest tax amendment bill included new REIT legislation in a draft form. So the industry's had an opportunity to comment on that tax legislation or that draft tax legislation, and we're hoping to see the new final tax legislation towards the end of October.
I want to ask you a very personal question here. And I promise you, if you work for the Treasury or SARS, go and make a cup of tea, okay? And come back in about 3 minutes' time. How difficult was it working with Treasury and SARS?
Yes.
Or is that a perception that it's difficult?
My experience, and we deal with different levels of government and different departments of government. My experience has been incredibly positive with my dealings with National Treasury. Now, clearly the wheels of government turn reasonably slowly, but certainly in the past 2 years, the response we've had and the level of knowledge and the level of effort that we have experienced that National Treasury have invested into our relatively significant sector has been impressive, and the individuals that we've been dealing with there at the highest level have personally taken the time to understand the industry, to understand the international context. So they have made the effort to go to London, for instance, to meet with representatives of the European Property Association, as well as representatives of Her Majesty's Revenue Services there that actually have recently gone through this kind of process, and to really understand what the issues were. They're still busy doing some work where I think in 2-3 weeks' time they're going to be going to the USA, meeting with the IRS, with their regulators, and with the North American Real Estate Association. So there is definitely a huge amount of effort that these guys have put in. They understand the importance of this sector, and literally from the Minister of Finance himself, right down to his officials in revenue as well as National Treasury tax policy side, we've had an incredibly good experience.
Well, I'm very glad to hear that. It's really nice to hear. We're coming back in just a moment. One of the things that Estienne raised was investor cash inflows to South Africa in this very important part of the market, and we're going to start looking at that part of this whole equation in just a moment.